It's time to get familiar with startup equity for employees. Many of our coaching clients return to me for help navigating the complex equity landscape because it's hard to figure out if the offer you got is fair. From vesting schedules to RSUs versus stock options, we'll cover all the essentials that you need to consider before signing the dotted line. My name is Jean, and previously I was a software engineering manager at Facebook, where I was responsible for leading teams and hiring engineers from interns to senior managers. At the end of this video, I'm going to share the best advice I've gotten when it comes to equity for people in tech. So if you're ready to jump into action, give that like button a tap and let's dive in. What is equity? Software engineer equity is one of the most valuable benefits of working at a startup. Equity is basically ownership in the company, and it comes in two flavors: stock options or restricted stock units, RSUs. They both represent ownership, but they have different tax implications and vesting schedules. A stock option is essentially a right to purchase shares at some set strike price based on fair market value. This price is set at the time of the grant and usually depends on the valuation of the company. One thing to note is that this price is usually not negotiable because it's set for the entire company. One major difference between stock options and RSUs is that with stock options, you need to actually exercise your options to own them. And I'll talk more about exercising in a bit. On the other hand, RSUs are essentially a payment to you that you accrue over a vesting schedule, which I'll go over in a bit. How much is your stock worth? Now that we understand the basics, let's go into the valuation. How much is your stock worth? If your offer is with a public company like any of the FAANGs, the valuation is the current stock price of the company, which is public information. And you just need to multiply the number of shares by the price. But valuing your equity can be tricky if your offer is with a pre-IPO company. It's impossible to know the true value. The only way to really find out is if there is an exit, which I'll explain later in the video. Some startups, especially later stage ones, will share their valuations publicly, and you can just Google it. But some startups will keep the valuation confidential, and I always advise people to ask for it during the offer stage. The worst that can happen is they say no, and if they say no, ask for the reason. If the reason that they give you is not convincing, it could be an indicator that the leadership at the company may not value transparency. I would take that into consideration on whether I want to work there, because that's an indicator for me that the leadership is likely going to be vague about other plans or decisions in the future. Now, there are valid reasons for companies to not share valuations publicly, and I talked about this in my other video, Startup Equity Negotiations, so check that out. Many companies will just tell you either the percentage of the shares or the number of shares you have divided by the total number of shares, and you can just calculate exactly how much your equity is worth based on current valuation. If you have offers you're not sure about, drop them in the comments and I'll do my best to help you out. Vesting schedule. I've mentioned the vesting schedule a couple of times, so let's go over it. Most companies have you vest the RSUs over 4 years, and the vesting schedule will usually be split into 4 years evenly, so 25% every year. So if you get 100 shares, you'll get 25 shares every year you work. Occasionally, companies like Amazon have a crazy vesting schedule like 5, 10, 30, 40, and this is so that they can incentivize people to stay with the company longer. And my personal opinion on this is that I would generally not want to work for a company like this because this is an indicator that they suck at retaining talent. They are trying to hold on to people by withholding their compensation instead of providing them more incentives so that people want to stay with the company. Ideally, you would want to be at a company where people love the work or the company's mission and not because they're withholding your compensation. But of course, everyone's different, so make sure you evaluate it for yourself. If you've seen other vesting schedules like this, I'd love to hear about it, so drop it in the comments. What are the exit scenarios? You'll hear people talk about the exit strategy or exit scenarios. If you're not familiar with this is just a way that you can actually cash out your vested shares. If you're new to the private sector and stocks, it's very different from New York Stock Exchange. You can't just decide you're over it and cash out. It's not like breaking up with a pair of shoes you never wear anymore. The company has to either have an IPO or get acquired for you to get any money from the shares. Before an exit, it's just numbers on the screen. Sometimes there are secondary markets you can use to cash out a portion of your equity, usually startups will have windows open to cash out a certain amount and may have other restrictions. So you'll have to check with your company. How do you exercise your options? When professional investors talk about startup investments, they say it's a long-term game, meaning they don't expect a return for 10 plus years sometimes. If you stay with the company until an exit event, then it's a great bonus. But if not, your equity could end up worthless unless you exercise it, which means to buy your shares. If you decide to switch jobs, many companies require you to exercise your options within a certain amount of time period after you leave or you lose them. For example, when I got my options at WhatsApp, I was in my late 20s and I didn't have much in savings, so I couldn't actually exercise all of my shares. Some people take out loans to exercise them, which could be a huge gamble. Luckily for me, WhatsApp was acquired only a year or so after I started working there, and I could cash out my equity without having to exercise all of them. So unless you have a huge amount of savings, get ready to take a big gamble if you decide to exercise your options. What's the best advice I've gotten about equity? People have different opinions when it comes to taking risk with equity, but most would agree that equity is the best way to make a life-changing amount of money in tech. This is the advice I got from someone who's experienced multiple exits in his career. He was a founder of a successful startup and an early engineer at another successful startup, and they both got acquired by large tech companies. Professional investors can take big risks because they invest in hundreds of startups all at once. Statistically, 99% of startups do fail. So these investors spread out their risk by investing in a lot of different companies. This is really how tech investors make it big through startup investments. Big name investors like Ashton Kutcher or Chris Sacca are able to take these big risks because their portfolios are made up of tons of small investments. As individual engineers, though, we can't work at hundreds of companies all at once, but we could spread the risk out by diversifying our equity across multiple companies. He said that if he could start over, he would vest shares with as many companies as he could. This means he would stay with the startup for a couple of years to vest a significant amount, usually 50%. And once you've been there for a couple of years, you have a much better understanding of where the company is headed and if they have a chance for an exit. If you think at that point the company has a chance, you can invest another year or two. Otherwise, you can move on to the next startup. And that's a pretty smart way to think about software engineering equity. Spread out your risk and maximize the chances for success. Hopefully, this video has helped you better understand software engineering equity. If you found this video helpful, please give it a like and subscribe to my channel.